This is Natalie Pace, and today I am very honored to have Kelley Wright. He is the managing director and really the chief person behind Investment Quality Trends. Investment Quality Trends, actually, the founder, Geraldine Weiss, was one of the most respected value newsletter editors on Wall Street. Kelley has remained true to her vision. And the question today for Kelley, in addition, he is a decades deep experience. So we're going to definitely ask him about his crystal ball, where the economy is heading, how does that going to play out for investors? But we also want to know in today's world where we are really drowning in debt, is the same model that Geraldine Weiss developed so long ago for value investors, is it something that is still relevant? And has he had to make some tweaks along the way since we have so much debt? All this and more in my exclusive interview with Kelley Wright, Investment Quality Trends. You can watch it back at youtube.com/Natalie Pace, or you can listen as podcast on Substack, Natalie Pace there as well. And we'll get started in just a moment. Okay, Kelley. So yesterday stocks were hitting an all-time high, and of course the headlines were saying, "Oh, investors are so excited that the government's going to open up." And then the government opens up, and today we see the Dow drop, 798 points. What in the world is driving all this volatility? I mean, it's certainly not the headline. I think they're just grasping for reasons on it, right?
Yeah, I mean, let's face it, it's not like the broad market is just recently hitting, you know, ridiculously high valuations. I mean, it's been up here for a while. I mean, it's defied gravity. So I don't think that the news is just starting to settle in. There's a couple things could be going on. Dow made new highs, and I read, what was it? I read a headline. It's starting to broaden out, and now it's bringing in the blue chips and the value. So, yeah, this is a glorious bull market, and I don't know, it could be a buy the rumor and sell the news kind of a thing. Um, I don't know. Maybe people are starting to figure it out. I mean, I've been talking and writing about it forever. The valuations are on the broad market. It's the highest it's ever been in history, and that's taking into consideration some pretty bad periods like 1929, 2000,
Yeah,
2008,
yeah.
blah, 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 blah. I mean, yeah, the valuations are mind blowing. So,
Yeah. And I think we should point it out, right? Like the Dow actually dropped what, 55% top to bottom Great Recession. The Nasdaq dropped 78% in the
yeah.
dot-com recession. 78%. So let me ask you this. We're going to talk about how defensive strategies in just a moment. I was reading, you have this fantastic newsletter. Everybody should go to iqtrends.com and learn more about investment quality trends. But in there, your own indications didn't say that we had hit the top yet.
Yeah.
What's going on there?
Good question. Beats the hell out of me. um, the market is dynamic. Um, I wish I could give you like this really great answer, other than I will notice this
Right.
is that quite a while ago, I mean, in the last few years, I saw my undervalued category was in the high teens.
Right.
That's been coincident with market tops,
Okay.
but the market didn't top.
Okay.
It's just been going. But since then, my undervalued category has been slowly, slowly, slowly expanding.
Right.
So that tells me a couple of things is that A, the market is becoming more concentrated
Right.
in an area that's not our expertise, that's not high quality dividend, paying blue chip stocks. Um, so yeah, so the market's becoming more concentrated into the speculative, tech area.
Yeah.
So investors, and if you look at my undervalued category, it's pretty interesting. A lot of consumer staple stocks. All right, now staples are, come on, I mean, they're dull, they're boring, they're vanilla.
Yeah.
nobody cares until they do. So that tells me also then, so investors, their appetite is not whetted by the more conservative return oriented parts of the market. So there's information to be gleaned out of there. Yeah, we'll see.
Well, I mean, I am going to talk to you a little bit more about the Magnificent Seven. It's interesting because everybody's been talking about a K-shaped economy, right? Where the richer, getting richer, and middle class and lower is really struggling, right? And what's interesting is there's been more recent talk. I had actually reported on it a week ago about a K-shaped Wall Street. That's what's happening too, is that we're seeing the
Mm.
older companies, what you would consider more the blue chip versus the Magnificent Seven. And of course, the Magnificent Seven, we got to talk about, valuations there particularly. And also volatility. Since you don't follow them, I do follow them. I will tell you, when they are strong, they take the market to an all-time
Oh,
high.
sure,
When
sure.
they're weak, and I'm just talking about a 5-year period. When they're weak, they lead them to the bottom. So
Oh, yeah.
which ones were tanking on April 8th? You could have bought Nvidia for like under $90 a share. A lot of them, whereas the market had dropped, right almost to the point of a bear, it did drop to 20% down. But anyway, so let's talk a little bit about valuations. But I'm also curious because I am
You,
sure.
real quick, you brought up April, and there was a really interesting dynamic.
Yeah,
It was the institutions that took the market down.
yes.
But
And
then
that's always
retail,
the way.
yeah, because institutions always get out first.
Exactly. And I
And
think
re
that's what
and
made
retail
it, yeah.
said, yeah, we're not buying it. And retail came in and bought the dip.
Yes.
Uh, and the institution said,
Okay.
okay, well, if that's what they want to do, then yeah, let's all get in. And
Yeah.
it was just a weird dynamic.
No, but I think that's another thing that we need to reinforce again. You're the one so famous for saying when you wait for headlines, you're late, right? And that's what I think a lot of people don't realize is that by the time they announce the headline that we're in a recession, we are 7 months into it at minimum. And oftentimes they've really kicked the ball, so you're hearing, oh, everything's totally fine. Don't worry about those
Oh,
negative.
sure. Oh, sure. Yeah, come on. Everybody get in the pool. Let's go. Yeah.
Yeah, yeah. Don't, there's not sharks there, but you're right. The whales are always the one that lead it down. But you are right also. And it's interesting because I've heard a lot of analysts talk about the retail trader who has never, and a lot of them have never been in a recession.
Oh, they've never seen a bear market. They don't know what a bear market looks like.
Exactly. And those are the ones that are buying the dip. And
Mhm.
but also those are the ones that now have to pay their student loan debt where they didn't have to a few months ago. And, other thing, we're seeing other distress coming up. So, people do at some point have to sell their stocks and they can't buy the dip.
Yeah, there's an interesting. I was discussing this with a friend of mine the other day, and he was making the analogy that we have a very much an app oriented. Um, oh, how would you say? It's just people are more app oriented.
Yes.
Okay, and during the pandemic, I mean, a lot of people were at home, couldn't
Yeah.
go to work.
Yeah.
They got free money,
Exactly.
and I'm going to start doing FanDuel and all this other stuff,
Right.
and and so they're gambling,
Yes.
and then they go, well, wait, this stock market app looks a lot like my. Oh yeah, I can do that too,
Yeah.
and yeah, it's
Yeah. The gamification
curious to see
is
how it
going.
all plays out, but that's
Well,
you
I
know.
can tell you as a parent of a millennial how that one played out. Like a lot of those meme. Well, all I have to do is mention the names: GameStop, AMC, BlackBerry, right?
Oh yeah, yeah,
These
yeah,
were all meme stocks that everybody was going gaga over, and they're really in the toilet. So, okay, so let's talk a little bit. Now, I know we should talk more about your newsletter, and the returns of your newsletter over time are really superior. I already mentioned Geraldine Weiss and how, but I want to just touch on Magnificent Seven and growth before we go into your area of
sure,
expertise. 'Cause I know
sure.
that you do study markets and you are a wise guy. a wise guy. Um, do you invest in growth personally? Is there a place for growth in a portfolio in a well-diversified plan? And how do you want people to look at your newsletter? Like, is that a one-stop shop, or if they are, if they have XYZ amount under management, can they call you up and go into the management side of your business?
Sure.
Like, what is it that you think a diversified plan really looks like? And what are you telling the people that do read your newsletter about diversification and also rebalancing?
Sure. Okay. So diversification is your friend. Okay. Diversification can cure lots and lots of ills. All right. And so, from my perspective, I mean, my world is my universe.
Right.
Okay. I eat my own cooking. Okay. What I would suggest to people is to do what you tell them to do, which is for number one, get a plan. All right. Get a plan. I want the part of the portfolio that is more conservative, that is more, dividend oriented, more value oriented. I tell people, look, you know, if you want to give me 100%, great. All right. Um, but you should you should have a diversified portfolio. And yeah, what I do is part of it. I don't expect, I mean, I do have clients who say, I'm all in, this is it. And it's okay, great. I mean, with my own personal money, this is it. I'm all in. But I'm a little bit different. I can manage a little bit differently than I tell other people to do. So, but yeah, asset allocation is important. Diversification is important. You need to have exposure to assets that are not correlated to stocks and bonds. I mean, that's just good, sound financial planning. And
Yes.
and that's your world, that's your bailiwick. You're the best at it.
Oh.
I just live over here. And
But
you
you
know,
are, and let's talk a little bit about your returns because I was also, look, the Lucky 13 is kind of matching what the Dow did this year. S&P is higher. Um, but um, But what I was also noticing is that in 2000 and 2022, when the S&P lost 20%, it looked like your portfolio didn't lose. Actually, you earned a little bit, or you only lost a little bit. Like you were
yeah,
way outperforming in that year.
yeah, yeah. Well, if you go and you look at the entire history, which we
Yeah.
started in 2000, I mean, those first 3 years, 2000, 2001, 2002, that's when the S&P lost 55%. That's when the NASDAQ went down 88 some odd percent. We were doing 30% in the 20s and in the high teens. So, but that's because what we do is the exact opposite of what was happening in the tech wreck. I mean, we,
Yeah.
we were just 180 degrees in the other end of the spectrum.
Right.
But if you look at the entire length of the Lucky 13, the compounded average growth rate since 2000 through 2024 is about 11.5%. And believe it or not, it's about 4% better than the S&P over the same time period.
Wow.
And that's with some pretty wild bull market stuff going on. So,
Yeah, and pretty wild bear market stuff going on,
and some interesting bear market
right?
stuff.
Very, very wild volatility. So let me ask you this, and this kind of plays in a little bit to that bifurcation. Are you at all concerned? Because I was looking at the debt levels, and when
Mm.
you line up the debt levels in the US, like a lot of people are well aware of that 38 trillion in public debt. Very few are aware of the 104 trillion in total debt and loans in the United States.
Oh, sure. Yeah, it's
Very
off the
few.
charts.
It's double what it was in the Great Recession when we had a financial crisis. So you are a value investor, and a lot of your dividend paying stocks are the ones that have the most debt. How
Uh-huh.
do you sort out and make sure that do you have one of your filters is a credit worthiness filter?
Yeah, I don't really show it in the newsletter. It's something I look at. I'm aware of it because I've got X amount of room.
Right.
Um, but this leads into something that's really important. back in the day, I used to look at our universe, and Geraldine and I would talk about this.
Right,
And I would say, Jerry, help me understand something. Here is this great high quality company
right,
that meets all of our criteria, and it's just languishing in what we call the undervalued area, which is at its low price, high yield.
right.
What's the deal? What's going on? And Jerry said, honey, that's the market. Sometimes the market doesn't care until it does. And then when they do, then the stock takes off. And I said, okay, I get that. I understand that. The value area of the market can go unloved for, long periods of time. But intellectually, that didn't really answer my question. And so I kind of got into this thing, and especially at the financial crisis, because we got killed. We got absolutely killed by the banks
Yeah,
because they had a lot of off balance sheet stuff. We
yeah.
we didn't understand. Okay. And I said, hey, look, this is never going to happen again. So I finally figured out, and it was like an 8 year deal, 8, 9 years,
Right.
to look at the internal cash flows, the numbers that can't be fudged, the things that.
Mm.
Okay, so there's three numbers that I look at real important now, and I'm not going to get into it because it gets over the hills and through the woods. One is return on invested capital, and that's just how much money is the company making on the money they have invested in the company. The other one is free cash flow yield, and free cash flow is just a fancy name for profit.
Right.
And you divide it by the enterprise value. And then the third thing is the price divided by the economic book value, which is it's an equation and it's a ratio and you can get to it and yada yada yada.
Yeah.
Anyway, I found that these three measures, and they have nothing to do with gap accounting. That was the other thing. I've got a
Mm.
big issue with gap accounting, but I'm not going to waste your time with it right now. You and I, we'll flesh this out another time. But the companies that were languishing in the undervalued category, I looked at their cash flow and it was like, oh, now I get it. Now I understand. They might have had revenue, but they didn't really have profit. And the market still had them priced too richly above their economic book value. So
Ah,
it's like, so now I can look at a company like you brought up,
right.
and on a gap basis, yeah, they've got high debt. Okay. But then when you look under the hood at their cash flow, it's like, pfft, these guys are printing money.
So the Apple would be a good example of that, but also I'm sure you have others that are in your thing, right?
Yeah, Apple, I mean, Apple's killing it. Apple is absolutely killing it. Now, they're not in my universe, but I've gone in and I've looked at them.
They're not even a baby blue chip?
No, not yet. Well, they went through that period where they dropped their dividend,
Oh, I remember. I remember. Okay.
and so they haven't had enough time. I've got enough data though that I can do what we do, and based on what we do, I would call them overvalued.
Oh,
But yeah, yeah. Well, in
ding,
Microsoft
ding, ding.
and Microsoft too. I mean,
Yeah, yeah,
but their revenues are through the roof.
yeah.
I mean, they're both growing like crazy.
Yep.
Um, and but they're rich, man. I mean, God, they're richly priced, and but people are paying for the growth. So
Yeah, this is true. Okay, so I'm going to ask you a few things that I get hit with a lot, and I just want oh, what do you think is going to, before we do that, let's look into your crystal ball. What do you think is in store for 2026? I just got off the phone earlier today with a gold executive. His name is Rob McEwen. He's been around for about 40 years, and he's just a treasure trove from that materials angle. He also has a copper company. And he was saying that he's been hearing that inflation's just really going to become entrenched and go crazy. What are your predictions for 2026?
well, I'm a bottom up guy. I don't really do macro top down because it's just not I'm
Right.
not that smart.
You are
I,
that smart. I know you know. I know you you know what you think you know. And that's the crazy thing is that, okay, we'll preface this with, I know that I didn't write down the full quote, but economists always say we have a great deal of uncertainty around this outlook, right? So you're going to say that, and we're not an economist. We're just here, people with 30 years deep of experience. But I know you have an inkling of what you think.
So, um, it's going to be interesting to see how the courts rule on tariffs.
Oh, that is an interesting point. Because what? We have to pay everybody back if they say, oh, crap.
Yeah. That's
That
going to be
would
a lot
be,
of money.
investors would not be happy about that at all.
It's going to be a lot of money. On the other hand, I think if the courts rule against Trump, then I think we might see a blow off top. I don't know. Call me crazy. It's rattling around in the back of my head because so many people are just so against the concept of tariffs. Now it's interesting. There's a whole body of
Yeah,
economics called tariff theory that goes back to the 16 and 1700s. And,
right.
and it's actually what the framers had built into the Constitution. And it's how we made our money as a country up until the progressives came over from Europe in the early 1900s. And then we had taxes, blah, 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 blah. So, I mean, there is a body of knowledge about tariff and how they work.
Right.
And I think probably 90 some odd percent of the people they hear the word tariff and then they have a misconception. I mean, it can work if it's applied correctly. But anyway, that's another
Well,
thing altogether.
I'm so glad you brought it up, and we should have this one off camera about that. I mean, I think that a lot of the analysts that I read about tariffs, they really are just going back to the Great Depression, and they're saying they're saying, oh, it didn't work then, and then look, we had the Great Depression. But you're saying it goes back to the 1600s, and that could be a different story. So I also want to make one point about tariffs is that the US, like I pay this, most people are paying as little or less for their clothes than they paid 30 years ago. And that has
Yeah.
a lot to do with making China the factory of the world. And what happened is that we got very accustomed to paying these very low prices by having this global economy. And of course, because we were importing so much, we had
Hmm.
a deficit with the world. So it is understandable that we have to figure out a way that we don't completely have a deficit with the rest of the world all of the
And
time.
and it hollowed out the industrial class in
Yeah,
America.
yeah,
There was a lot of socioeconomic
pain.
negatives
Right.
associated with that.
Yeah.
And
And
you know,
I think that full-bodied picture is, and that's part of, I mean, we don't have to drop down too far the rabbit hole, but that's part of the reason why I think it's so important for people like you and I. We're talking about economics, we're talking about hopefully how Main Street can navigate this very volatile environment. The 21st century, if nothing else, is volatile, and
yeah.
you have to understand how to manage that because and this is something I did want to also bring up. You brought it up when you talked about the whales taking it down in April and then the retail investors buying on the dip. Well, a lot of times people are doing the wrong thing on their emotions or
Oh, all the time.
yeah.
All the
So
time.
the
Yeah.
markets go
Yeah.
down and they sell, and the
Yes.
markets go up and they want to buy high. And
Hmm.
so I want to just talk about that. Like your value approach is really a grounding approach and a sobering approach. And I think more people should have that idea. They definitely should have a piece of value in their portfolio. We have three slices of 10 in the equity side that are value slices. Some of them are smaller. I think you deal most
Sure.
of the big, large blue chips, but even let's just talk about that, about how the value investor approaches managing emotions.
Okay, and so yeah, this is a great discussion. So first off, we come from the place where investing is a business. It should be thought of and treated as a business. It's not a lotto ticket. It's not casino. It's not bet on Black 19. It's a business. You are buying a ownership interest in an operating company. Yeah, you're not responsible for the day-to-day management. That's not important. You're still an owner. Let's think like a business owner. So we think the sole purpose of investing is to get a return on investment. If you're investing for any other reason, yeah, I don't think it's going to work out for you long term. It's not entertainment. It's not something to do if you're bored. Like I said, it's a business. So I think that buying stocks can be boiled down to two words: what and when. That's it. Everything else is just discussion.
Right.
What do I buy and when do I buy it? How long do I hold it and when do I sell it?
Oh,
Okay.
you guys always do that too. You have basically a buy and a sell prompts, don't you?
And we have a hold discipline. I mean,
Yeah.
everybody that does what I do has a buy discipline.
Right.
Very, very few have a hold discipline or a sell discipline. So we've got a qualitative filter. It's six old-fashioned, old school Graham and Dodd fundamental measures.
Right.
There's 4,300 publicly traded stocks. There's only currently 297 that pass our filter. Okay. So we discard the rest and then we take a look at those 297. And what Geraldine did is she found that high quality companies tend to trade between two repetitive dividend yield areas. And
Hmm.
I talk with my hands and I can't help it. So one where the price is low, but the yield is high, and the other one where the price is high and the yield is low.
Right.
I mean, and you look at our charts and they show you this pattern, okay? And this is just a shared characteristic of high quality stocks. So we can look at the pattern,
Right.
which has been defined by the marketplace.
Right.
That this is not a subjective thing. I mean, we're kind of acting like behavioral scientists. We're observing the behavior of the market,
Right.
and millions of investors who do not know each other seem to coalesce around the idea that XYZ stock is a great buy when it yields this. And by the time the price climbs and the yield drops to that, all the value has been wrung out of it.
Got
So
it.
so that's what we do is we let the market tell us, okay, this is the time to buy this stock, and then you hold it until it gets to that other repetitive area,
Right.
and you get all those dividend increases along the way, you get all that capital appreciation along the way. But then when it gets to that high price, low yield area,
Right.
hey, declare victory, plant the flag, sell it, and
Yay!
yes, yes, do the Snoopy dance and roll your proceeds into another stock that's its low price, high yield area. And that's it. That's all that we do is we identify what
Yeah.
and then we identify when. And we keep it simple. That's it.
Well, it's a pretty time-proven formula on the value side. And I'm glad that I did ask you the question if you'd made any adjustments based on, the amount of debt. Okay, I know you follow the Fed like I do, right? And we've had financial engineering that has been helped
Very kind way to put it. Yes.
helped a lot of companies that would have already declared BK.
Oh yeah.
Right? A lot. And they've extended durations beyond the lifespan of some of their investors. Anyway, so I'm just wondering, how do you feel about, I mean, we see areas like, I mean, all you have to do in Santa Monica is walk down the street and you know that commercial real estate's not doing so well. So we see
Sure.
a lot of areas that are really run down, heavily indebted. They are not coming back to the revenues of pre-pandemic. Are you worried that this is going to snowball, or do you think that under Jerome Powell and their new way of, printing up money and throwing it at companies that would be bankrupt, is this going to keep everything flowing? Or are you worried about this debt, as particularly this very
Yeah.
distressed debt that we've been financially engineering to keep alive? They're on life support.
I worry about a lot of things. And no, I do. I do because if you look at every crash, every crash has had a set of clues that were present, and all that was necessary to reveal
Yeah.
is a trigger. Okay, you can go back to 1973, 74, the OPEC.
Hmm.
We went to bed and oil was $3 a barrel, and we woke up the next day and it was $12 a barrel.
Oh boy.
That was a macro shock to the world, but also we had wild valuations in the stock market because that was during the period of what we call the Nifty 50. You young kids, go Google it, okay? Um, the 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 50 blue chip stocks that it didn't matter what you paid for them ever because their earnings were going to grow to infinity.
Oh boy,
Okay,
doesn't that sound like the Magnificent Seven?
it's so much so.
Right.
But so,
Yep.
yeah, so we had overvaluation,
Right.
a lot of leverage,
Oh boy.
a lot of debt,
Yeah.
a
Oh boy.
lot of debt, okay? And so those were clues, and they were just waiting for a trigger, and then the OPEC decision was the trigger. Um, Go to Japan, okay? Real estate never goes down until it does, okay? And then the whole Japanese thing collapsed in the night in
And
early
has
19.
never recovered.
It hasn't. It hasn't. I don't know how many times. We'll go to the dot-com era.
Yeah. New economy.
Earnings,
Remember the
earnings.
new economy? I think that was coined by Jen Kramer.
Yeah, the earnings. What?
Oh, 5 years of negative earnings. Yeah. Oh,
You
yeah.
don't need to
You
worry
know?
about earnings. We don't need no stinking earnings. I mean, so yeah, in at the end of every bull market,
Yeah.
yeah, there's clues, and they're just waiting for a trigger. So I don't know what the trigger is going to be. Um, is it going to be a bank that collapses and there's no going in and saving it? Is it going to be a giant real estate concern saying, yeah, we don't have the cash flow and our debentures are worthless? You know, I don't know. You and I can spend probably an hour thinking of all of the
Yeah.
various things, but yeah, debt scares the hell out of me. You
Okay.
know, Geraldine used to say, debt is the albatross that hangs around a company's neck, you know,
Well, we
and you
still
just
have a
just dragging it. Yeah.
we have a colony of albatrosses out there.
Oh
Um,
yeah. Well, and you know what? No, and part of it is, hey, the Fed has created this. Uh,
yes.
the Fed has created this
Mhm.
belief that, yeah, all right, we can do some things. They probably aren't smart. They're probably not good. We're probably breaking our fiduciary responsibility. But you know what? We've screwed up so bad that the Fed is going to have to come in and save us from ourselves. And that's what they did. They've done it a few times, and at some point, I think they've got to let certain things crash and burn. And
That's capitalism, isn't it? Right?
yeah, yeah. What did Buffett said that capitalism without failure is like Christianity without hell. You know?
He's got some great. Okay, so that leads me to my next question, and it doesn't have. I looked at your list of the companies you follow, and I did not see any mining company. Am I wrong about that?
On the faded blue chips, I've got Barrick Gold.
Okay, faded. Because the price got too high?
No, their quality ranking dropped. Their S&P
Oh,
earnings dividend quality ranking dropped below B plus, and that's an old Geraldine indicator.
okay.
Um, yeah, so we've got a section in the newsletter called Faded Blues, and those are stocks that used to meet our criteria, but for whatever reason, whether it's short term, medium term, they don't meet it right now. But I still publish the list because I mean, there's people that held on to them, and so
And you want to say basically you might keep them on your radar.
well, because their undervalued and overvalued yields are still valid.
Right.
You can
Okay,
still
so
watch them.
My question is, when I get people, coming on my video conferences that I do and asking questions, inevitably there's somebody that's there who says, I've been hearing that the dollar's going to become worthless, and
Right.
BRICS currency is on the rise. And I think I should go into blah, 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 blah. Like, it's usually gold or crypto, depending on who's hitting them up. Some people have actually purchased like Iraqi dinars and Venezuelan stuff. It's crazy what goes on out there.
Oh,
I
I know.
want to say, what would you tell people that are afraid of debt or the things they hear? And it is something to be concerned about, but how do you monitor all of the noise that's going to hit you? The minute you show that you're afraid on social media, you're going to become bombarded with emails and ads
Oh, yeah.
that stoke
Sure.
that fear and try to sell you a panacea that's probably a scam. So, what do you say to those people that are afraid, and what should they be looking to do, and how do they shut out the nonsense?
So my first teacher was my grandfather, who was a Depression era guy. And my other major influence besides Charles Dow and Benjamin Graham was Geraldine Weiss,
Right.
also from the Depression era.
Mhm.
So I learned from both of those mentors a certain respect for the possibility that things can go to hell in a handbasket.
And
Okay.
stay there for too long.
And they can. So my approach to precious metals is I've always been a believer that in a diversified portfolio, you should own coins, things that are currency that can be exchanged for goods or services. Yeah, I know you can buy bullion and yada, 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 and that's all fine, but you can't take a bar to a store and get food, or you can't
Right.
pay. So I've always been a big believer in if you're going to own precious metals, try to own the coins. And I'm not talking about the wild esoteric ones. I'm talking about, gold and silver currency, basically.
Right.
And that's just part of a diversified portfolio. Now, as far as currencies are based on confidence.
Yeah, and I think people should. Okay, thank you. Keep going.
So what's behind the brick? Brazil, Russia, China, and I forget who
India
the I is.
and South Africa. India, South Africa.
So let me ask you a question.
Right.
Who do you have more confidence in? That collection of countries
Yeah.
or the United States? And as long as we maintain the most powerful military on the planet, um, I don't see the planet throwing the dollar underneath the bus. In terms of it being the reserve currency.
Yeah.
That's just me. But hey, what's the Boy Scout motto? Be prepared.
Yeah, it doesn't hurt to have diversification. What do you
No,
think about crypto?
you know what? I'm just going to be honest. I don't understand it. I don't. I mean, I've sat down with like some really brilliant crypto people,
Yeah.
and I've told them, look, explain it to me like I'm, in sixth grade.
Right.
I have trouble with intangibles.
Right.
I'm your classic boomer. I need to be able to hold, feel, touch, and see something. I can value something that's tangible.
Right.
I don't know how to value, and I don't know. I don't. So I'm not the guy to ask, Natalie. I'm sorry. I don't get it.
Well, I think that that's important too, is that, when we understand, like, as I'll give an example, and this is something I wanted to ask you anyway. When somebody asks me about tax ramifications, I can talk to them about the difference between short-term and long-term capital gains. I can talk to them about what I've learned about donor advised funds and, the way that really wealthy people will to their kids without any tax ramifications through
Oh yeah.
loan study, all these different things. But like if they ask me, should I do a Roth conversion? I'm like, I'm not an accountant. You're going to
Yeah,
have to go over the nut. That's going to cost you something to do that. And so you need to talk to your accountant about whether or not that is. And also, what's your time horizon to be able to, build up enough gains to offset that. So, I mean, I think that is important for people. I always tell people, look, you should be the boss of your money and you should be
absolutely.
understanding that each one of these people that advise you, it's kind of like you don't go to your podiatrist to learn how to, lose weight. You know what I mean?
Generally, yes. Yeah. No, it's a great point because I get asked legal questions and tax questions all the time.
Yeah,
Do I have a certain body of knowledge? Absolutely. Do I know how trusts work? Yes. Do I know what a pour over provision is? Yes. Do I know what generation skipping is? Yes. Do I know what the kiddie tax is? Yes. I understand all those things.
right.
Um, am I the guy that you want to base a decision on? No, you need to talk to an estate attorney. All right. There's a lot of accounting that I'm well versed in. Okay. But look, I'm not an accountant. Okay. And I tell subscribers, I tell clients, there's things legally and regulatory wise and just being prudent. Don't ask me.
Exactly.
Yeah, you need to have a good estate attorney. You need to have a good CPA. You need to have a good life insurance agent who understands you and your needs, is not just trying to sell you a product.
Yeah. Yeah,
Yeah.
we could drop down the rabbit hole on annuities and how much the
Oh
life
my God.
insurance salesman makes on those. But I'm going to give you the last word. What do you think is the most important thing for potential subscribers to your news? So people can be a subscriber.
Hmm.
You can also come and have you do managed services as well, right? You want to talk about?
I have a separate company that's an RIA, that's a
Oh,
registered investment advisor.
okay.
Yeah. And I'm the portfolio manager and yada, yada, yada. So, yeah, I do have subscribers that are clients, and I have subscribers that are just subscribers. And look, investment quality trends is a toolbox. All right. I'm handing you a toolbox. If you're smart enough and you work hard enough and you can save money, you can do this.
Right,
You can do it on your own.
right.
I'll give you the toolbox. I'll show you how to use the tools, and you can do it. Now, there are people who, look, they're too busy. They don't want to get involved.
Right.
They lack the confidence, yada, yada, yada. If that's the case, then yeah, we'll do it for you. But I try to talk people into first, you can do it. You can do it. Do it yourself. I'm probably the worst marketer on the planet because I don't say, yeah, here, give me your money. No, here, you can do this. Be in control of your own stuff. Nobody cares about your money more than you do. Trust me. Trust me.
Yeah.
You know, yeah.
Well, I mean, even if they are using you and even if you're managing it, I mean, I tell this to clients all the time, my coaching clients. Obviously, I stay on the education side. I don't manage anybody's money. I stay completely on education side. But, even if you have somebody managing your money, you should know what is going on and you should be the boss. And if they're just talking over you, they aren't explaining it to you in a manner you understand. Or if they're using sales things like you wouldn't do surgery on yourself or, any of those old sales lines, then, right?
Yeah.
They're just red
Yeah.
flags.
It's funny. I got licensed initially in 1985. So yes, I'm old, I'm a boomer, but okay. But a couple of years ago, I think it was the North American Securities Administrative, blah, 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 came up with these continuing education requirements.
Okay.
Yeah, and I got an email from the state of California that said, "Hey, bub, you need to catch up on your continuing ed." And I said, "What are you talking about? I've been in this business since 1985." They said, "We don't care. If you don't catch up on your continuing ed, we're going to pull your certificate." And it's like, "Oh, well, crap. I guess I better do it." And so I
I
just
know you can
finished.
teach the course, but go ahead.
I just finished a module on ethics.
Interesting.
It's very, I know, and as I'm reading the material and I'm going through it, it's like, damn, this is wild. And the material in these courses is developed from real world case studies of
Right.
things that advisors have done
Okay.
and are not copacetic.
Oh
You're
boy.
you're
Yeah.
not supposed to do. Okay,
Right.
some of them are common sense, but it's I was reading this and it's like it's amazing some of the links that some advisors will go to.
To make the sell?
Yeah, yeah. I mean, it's the antithesis of fiduciary responsibility. I mean, I was a registered principal. I was what was called a an OSJ, which is the Office of Supervisory Jurisdiction, which meant I was the compliance guy for a group.
Right.
And it's, so you get that stuff beat into your head. I mean, you don't do this, you don't do that, you don't, cross the line. But it's amazing that the industry had to go to this extent now that you've got to show them, yeah, look, I'm polishing up on all this stuff that I studied maybe 30 years ago,
Right.
and I'm completely aware of it. But, that's the business that we're in.
Well, it kind of reminds me, sadly, what comes to mind is all those people who get speeding tickets who go to drivers to get rid of the speeding ticket and then they go out
Sure.
and speed.
Yeah, yeah. It's, I
You know,
know. It's interesting. Hey, and let me tell you, the SEC
yeah,
and state regulators,
yeah,
there's certain things, if you cross the line,
yeah.
you can go to jail, you can lose everything. And you know what? If you take advantage of someone, you know what? You deserve what's coming to you.
I mean,
Yeah, but
sadly, I see people, especially I mean, there's some real out and out scams that are just heartbreaking,
oh
and
yeah,
they deserve it, they have no conscience and just take people for a ride. But I think that everything that you've talked about is super important. And what I always really admire about you, Kelley, is that, A, you're smart, B, you're observant, C, you adjust, right? You said, hey, I lost my shirt in the Great Recession, so obviously I need a few more filters here.
mhm.
And you're always transparent and your insights are spot on. So I just this we'll be sending this out to everybody. If you have any final words that you want to say, please feel free to say it.
Well, number one, I appreciate it. You and I go way back.
Yes.
I I admire what you do. You do stuff that I'm not even qualified to do or talk about. And she does it really good, folks. So pay attention. I love the market.
I know.
I I love investing. I mean, it really is the straw that stirs my drink. And I'm scared to death of it. I hate I hate losses. I move heaven and earth to avoid a loss. That's like my worst fear. That's the thing that keeps me up at night is,
Yeah.
oh God, I don't want to do anything where someone's going to lose money.
Yeah.
Um, but treat it as a business. Be the CEO of your own stuff. Yeah, get advisors, get their input, do your homework. Don't take everything at face value and don't take everything for granted. Um, be responsible for your stuff
Yeah.
because no one cares about you more than you do. You
Take
know,
ownership.
absolutely great. See, I could have encapsulated that in that word right there. Yeah.
No, no, no. I mean, it's just it's kind of what you've been saying. I mean, I learned from you. I've been learning from you my whole career, and I've been very blessed to have people like you teaching me. I was an English literature major. Of course, that was back, 25 years ago. And after hitting the ball across the net with you and Gary Becker and Kevin Murphy, I feel like I've earned my stripes a few.
Oh yeah. Oh yeah, definitely. You're oh yeah, no question. But hey, I'm a big believer in English lit. One of my daughters just got her master's degree in classical education.
Yeah. It's a
And
good.
we get into these great conversations about Western Civ and original document. I mean, it's wonky, geeky stuff, and I absolutely love it. And you can learn so much from classic literature.
Well,
So,
I learned something today. I didn't realize that the US depended upon tariffs back in Alexander Hamilton's day. It certainly
oh yeah, yeah, it's constitutional. It's how we made our money, and we had one of the greatest eras of prosperity, kind of between like 1850 and 1900. So, but that's wonky inside baseball, geeky stuff.
yeah,
So,
no, I appreciate you. And everybody be sure to go to iqtrends.com to find Kelley, reach out to him. And again, for value, you're not going to find anybody better. I'm going to go ahead and stop it here. We do have um, Jody with us. So we were so blessed to have Kelley Wright with us and share his wisdom from investment quality trends. Again, remember, you can reach out to him at iqtrends.com. He's on LinkedIn as well. He appears regularly on The Money Show. And of course, if you are wanting to find this and watch it back and you can't find the link, email info@nataliepace.com. Do share it with your friends. It's free. And we'll look forward to seeing you with our next, I do these video conferences at least once a month, often more frequently than that. We actually have two exclusive interviews this month. So if you haven't already watched it, be sure to watch my interview with Rob McEwen he's the chief in chief owner and also the chairman of McEwen Inc. The symbol is MUX. So thanks again. It's Natalie Pace. Visit nataliepace.com. Remember that in your diversified plan, it's always a good idea to rebalance. And rebalancing after the Santa Rally is never a bad idea. Our next retreat is going to be the New Year, New You retreat. It's January 17th through 19th online. You need to register now because the early bird pricing ends at the end of November. Go to nataliepace.com, click on the flyer. You'll learn the 15 plus things of life math that we all should have received in high school that's going to transform your life forever. You're going to learn how to save thousands of dollars annually with smarter big ticket choices. We've just got so much for so many reasons for you to attend. So I do encourage you to do that. The sooner you get the ABCs of money, the faster your life transforms. Again, email info@nataliepace.com. And thank you again for joining me. Watch this back, youtube.com/Natalie Pace. Substack, if you want to listen as a podcast, I'm Natalie Pace there as well. Share it with your friends. It's free. Thank you.